everybody, and welcome to Chapter 16. In this chapter, we're going to talk about employee benefits, group life, and health insurance. So let's start out with the idea of employee benefits. So when you get your first real job after college, you're going to be presented with a salary. And the salary is important, of course, but you're also going to get a varying amount of employee benefits in addition to your salary. So these benefits should be an important decision piece into whether or not to accept the employment offer. So if this is the only job that's hiring you, it's an easy decision. But if you're lucky enough to have multiple employers pursuing you, you may want to also look at the employment benefits as well as the salary, because you may have an employer paying you less overall annual salary, but you might have higher amount of benefits. Such things that you should think about is number of paid vacations. They can vary between companies a great deal. The amount of vacation time. Some companies you can start with 1 week's vacation, no week's vacation, 2 weeks vacation, 3 weeks vacation, and some companies now say unlimited vacation. You may want to think about the quality of the medical insurance, whether or not they offer dental insurance, educational assistance, employee discounts. These are all things that you should think about before deciding to accept an employment offer. Now, you also want to ask an important question is, what is your contribution to these benefits? So some employers will offer medical and dental insurance and life insurance and long-term disability plans, but they may forget to tell you that you're going to pick up the full cost of these. They're contributing nothing. So if you have a company that will pay for all of these benefits with no contribution from you, that would be, if the salaries are equal, I would choose the company that's going to fund and pay for your benefits directly, rather than you having to make a contribution or in some cases pay the entire amount. I know one company where the medical benefits were, they did have a group plan. The company contributed nothing to this group plan, and employees routinely paid $600 to $2,000 a month out of their salary, depending if they were single, married, or with family. So employee benefits are important to understand how they'll impact your life, the quality of the benefits, what benefits are offered, and whether or not you have to contribute. Now, this is part of the economic security overall as you want as an individual or family. So when I talk about economic security or risk management, if you are working and you're supporting a family in a household, and then you're disabled or die or get sick, then you want some sort of, these benefits can help bridge the difference between living on the street homeless and being able to continue to provide for your family and all your family's needs, even if you're unable to work. So, in the worst case, if you do die early and you don't want to leave your family with zero or half an income, so life insurance could be group life insurance could be a great way of supporting your family, even if unfortunately you die sooner than you should have. Okay. Let's jump over to some fundamentals of group insurance. So when you think of group insurance, this is very different than individual insurance, because the group insurance is going to be a pool of people involved. So many people are going to be covered under one big contract. And because a group is negotiating for insurance, costs are usually lower than what you'd pay individually, because you have that group lower risk dynamic of being in a group rather than being an individual. So coverage will cost less overall for the individuals within the group. Now, most employers are, of course, want to offer employee benefits, not because they're so wonderful and so thankful to their employees, but as a part of the competition. So if they're going to hire the best and the brightest at their company, they have to have a competitive insurance and employee benefit package. And this is something that when I first started my career, I worked with a lot of defense companies, and they hired a lot of technical engineers and highly skilled individuals. So they had excellent benefit programs. Later on, I went to work for other employers who did not have a larger base of engineering or science-based employees that they had to compete for. So therefore, their benefits were drastically less because the people they were mostly hiring were easy to hire, and the benefits, were not a factor. So these are things that, the type of company you work for, typically companies that have large engineering staff or a large staff of employees that are difficult to hire and retain will offer more lucrative and generous benefits. Now, the group insurers, there's certain principles that you need to understand. The group should not be formed for the sole purpose of getting insurance. That is sort of defeating the purpose from the insurer's point of view. From the insurer's point of view, they don't want a bunch of, say, older people or sick people to group together to try to get a discounted group insurance. What they want is an organization, like a company or a society or something that they're brought together for another purpose, and the group insurance is secondary, like a labor union, and there should be, the group should represent a diversity of people, and because they don't want all the same age or male or female, they want a diversity of people within the group to help lower the risks of the benefits being overly utilized. And the benefits would be determined by some sort of formula that the insurance company would have. So the insurance company would have a formula, and it would look at how many employees do you have, what is their average age, and different criteria, and they come up with what the group benefit costs will be. And then in order for the benefit, in some cases for the benefit to be eligible, there has to be a minimum amount of participation of the employees of the company. So therefore they want to pick a plan that would be attractive to the employees and encourage the employees to join. And the plan will need some administrator to facilitate the sign-ups, keep track of everybody, file the right documents, and things of this nature, all sort of part of that group plan experience. Okay. Now, the eligibility of groups and the status of being a group will be in the hands of the insurance company. So they'll develop a policy, and there's usually a state law or state laws that they have to follow, and in some cases maybe federal laws. Generally, there's a minimum size required. You can't get these group discounts with 4 people. And then as far as the employees of a company, they're going to have to meet certain participation requirements. One could be they must be a full-time employee, but that's not always the case. There are plenty of companies that will grant insurance to part-time people as well, or they might grant truncated insurance to a part-time person. Or what I mean is, if you're part-time, you can join the group insurance plan, but you may be asked to pay a higher fee or a higher copay or contribution, I should say. There may be a probationary period. Typically, companies can be anywhere. You can obtain benefits right away. Some companies make you wait 30, 60, 90 days or 6 months. It depends on the company. And it depends on the group insurance and what they discuss. So one idea is that there may be a lot of people who start a job and end a job quickly. So if they make it past 3 months, they typically stay a lot longer, but most people may not make it to 3 months. There might be a reason for having these probationary periods to kind of weed out people just jumping in and out of the job, or preventing people from taking the job just to obtain the benefits using the benefits and then leaving. So there are some sound reasons behind the probationary period, and this is going to affect the group insurance rates as well. Lots of times the insurance they have what they call open enrollment periods, with a certain particular time of year where you can apply for coverage or change your coverage. Oftentimes, companies will offer 2 or 3 medical plans that you could switch between them. And then typically you need to be actively working when the coverage begins. So these are just some common stipulations as far as the fundamental group insurance is concerned. Now there's also group life insurance. So if you work for a company, typically they'll provide some sort of group life insurance. And it's going to be a term life insurance. Now, it's usually that this life insurance is going to be a multiple of salary. So it's not uncommon for this group life insurance to be 2 times salary, 3 times salary. But it's going to be what we call low cost protection for employees. Typically much cheaper than you could obtain for yourself. Because from a life insurer's point of view, if they collectively insure a group of people within a company, that's going to lower the overall risks because you have a lot of people paying into the group life insurance. And it's frequently rare that someone dies during their productive working years. So between age 22 to 62, it's not that common. It's much more common for someone to die during retirement than during their working life. So the costs to the company are usually low for group life insurance, and the costs to the employees are low as well. In fact, many employers will usually pay the full amounts and provide you a basic life insurance at a base rate. And that amount of coverage would depend on, your earnings, your position. It could be a flat out amount for everybody. A lot of companies will say, we're going to cover 1 year of your salary as the base coverage for everybody. And then they give you an option if you want to do 2 or 3 times your salary as life insurance. You can pay extra into it from there in some cases. So that supplemental term insurance means that you can purchase these additional amounts that to where you feel comfortable. So a lot of companies will just give you a base amount, and then you can get the supplemental to a point where you're feeling like you have enough life insurance. Okay. So most plans are going to provide the group accidental death and dismemberment, what they frequently in the world of insurance and risk is known as AD&D insurance. So this is going to give you additional benefits if you die due to an injury that occurs in certain. If you die in the accident, especially if you die in an accident at work, there's besides life insurance, there's other liabilities to the company in that circumstance. But also if there's a bodily injury, if you dismemberment of a leg or an arm, so you're not you're not dying, you're not dead, but you lose a leg or an arm or your ability to work. The full benefit would be what we would call the principal sum. So this is paid if the employee dies in an accident, they'll get the full benefit. So there are different levels of what, if you die with it in an accident, you get the full benefit. If you die, due to other circumstances, you may get nothing, or you may get a reduced amount. For example, if you die based on a suicide, you typically don't get any insurance money. So these are things that, in the contract would be spelled out and something that employees should understand. But the group life insurance is something I hope you never have to need or use. It's much more likely you'll be disabled during your working life than die. Depressing topic, right? But oftentimes the coverage will be extended to your wife or your spouse or your husband and any currently dependent children. And then you can convert. Oftentimes you can convert this term life insurance to an individual cash value policy if you leave the employment. So sometimes if you leave the employment, you can There's varying options. In some cases, the life insurance gets terminated. In some cases, you can, convert to an individual cash value policy and continue to pay the premiums yourself when you leave employment. Oftentimes, when you leave one employer for another employer, if they have life insurance policies, you're just going to leave this one behind and pick up the next one at your next employer. And typically, when you would need this life insurance, it won't be available. So once you retire, typically you lose that life insurance, and then you would have to get additional life insurance for your retirement, which is a greatly increased cost. So the term, when they say term life insurance, it's usually only for a set period of time. Now, credit life insurance, this is something offered by banks, and it provides, for the cancellation of any outstanding debt if the borrower dies. So the credit life insurance would be a type of life insurance that, would cancel all the outstanding debts for the individual insured by the credit life insurance. So this is good for, a family where, if the breadwinner dies, it's hard enough to make up their lost income, let alone having to pay back their debts. Okay. So let's talk about the group medical expense insurance. So the group medical expense insurance, it's an employee benefit that's going to pay for the cost of hospital care, physicians, surgeons, fees, and other medical related expenses. And most people understand what medical insurance is. And the coverage is going to be available through some sort of managed care organization that we went over in previous chapters. Commercial insurers, Blue Cross Blue Shield plans, self-insured employer plans. So there are different coverages that we covered some of these in the last chapter. But group medical insurance is, it's not always the same. There are different aspects to it, which we're going to talk about. So a managed care organization, this is going to be a for-profit company that's going to come in and is going to manage the employee's care. So there's a lot to manage as far as striking deals with hospitals, with doctor groups and practices, and they're going to try and manage it in a way where they can procure discounts or procure stated costs in a way that's trying to reduce the overall cost of operating this medical plan. So trying to use the group aspect of being a large insurance company to negotiate to make the plan as cost effective as possible. And trying to figure out where they can control costs and monitor medical care use and work with the physicians. And, it can get very complicated as far as what they're willing to compensate physicians for and what physicians typically should be doing. And so it's having a third party in there to manage the care. So it's rather than just saying everybody has medical benefits, just whatever medical bills you guys incur, just give them to us and we'll pay them. They found that to be very expensive when there isn't a group in the middle to manage and leverage the size of the group plan to get discounts or get a better managed care or even just efficiencies of scale for filing paperwork and administrative type of costs and work. Now, commercial insurers, this is going to include, of course, life and health insurers that sell both individual and group medical expense plans. So plenty of commercial insurers are going to offer, of course, the individual plans and then the group medical expense plans as well. So majority of people who are covered by these management care plans, this is going to be established through where the coverage is managed by commercial insurers. So these are the big insurance companies that manage these large plans. So that's how the majority of people in the United States are managed, through these managed care plans. A great deal of them are established by the commercial insurers. When it comes to group medical expense insurance, we have these terms Blue Cross and Blue Shield. So Blue Cross is what we think of when we think of hospitalization and hospital costs and expenses. Blue Shield is what we think of when we're going to a physician or a surgeon's fees. So together, Blue Cross and Blue Shield plans should should cover all your medical needs. So if you were to break your medical needs out into Blue Cross, which is a less frequently used hospital expenses, and Blue Shield, which is the more frequently used physicians, primary care physicians, or surgeons. This is going to cover the full spectrum of medical needs that you would need, but from hospital to local doctor. So these medical plans need to cover, of course, the medical plan isn't going to be complete unless it's covering the hospital expense and the physician and surgeon fees and expenses. Now, lots of times, Blue Cross and Blue Shield are combined together, so it's one plan that you're going to buy to cover all of these. But it's not 100% of the times. There are plenty of insurance situations where you may just have a Blue Shield. You don't have hospitalization. So that's why you always want to be knowledgeable if you're getting medical insurance that it's going to be covering hospitalization as well as typical physicians. In many cases, this, as an end user, you may not be aware of that a lot of plans operate as nonprofit organizations, and some plans operate as a profit organization to try and raise capital. Now, in my mind, it doesn't make too much of a difference because it says nonprofit organizations, but a lot of these organizations do act in a way that they're trying to secure profits. And oftentimes those profits are just funneled into the salaries of the employees of the company, most of it going to the top positions of the company. And these top positions in the company can be making hundreds of thousands of dollars in salaries for some of these nonprofits. So just because it says nonprofit, don't think of that as low cost or better than for-profit organizations. Typically, I would say they're about the same as in effectiveness and in cost. Now, let's move over to self-insurance. Okay, so self-insurance is the concept where instead of hiring an insurance company to cover all the costs that are incurred, you as a company will pay all or part of the costs of the health insurance. And what this does, you're basically, as a company, you're taking the risk on yourself, and this would come at lower cost for the insurance. Here's an example. In your personal life, you're probably confronted quite often with retailers asking if you want insurance for your products, your computers, your MacBooks, your phones, your TVs. It seems like anything they can insure through a warranty extension, companies will be very aggressive of asking you if you want insurance with that. If you've ever been to Target or Walmart or Best Buy or even shopping on Amazon, they'll all try to offer you some insurance in your product so that if the product breaks, you can bring it back and have it replaced for free for a certain period of time. Now, me personally, what I had always tried to do in the past is refuse these warranties on the products. And anytime there was a product I had that had a warranty I passed up on, I took that same exact amount of money I would have spent on the warranty and I put it in a separate savings account. And over time, since I was well aware, working for manufacturing companies quite often, I was well aware that most products come with a standard 1 or 2 year warranty from the manufacturer. And all you have to do, it's a little bit more trouble, but if a product I have breaks, I will just take that product and contact the company, get an RMA number, mail the product back to them, the warranty will cover it, and then they return the product back to me at no cost. Or you could, certain companies like Costco will automatically for free have some insurance extensions that you don't have to pay extra for. And I know a lot of companies say appliance companies are pretty aggressive with this. Say a PC Richards and Son or any type of a solo appliance company will very aggressively try to sell these warranty plans that can be quite expensive. So you buy a $1,000 refrigerator, they want you to spend $200 more on a warranty plan. So after a certain amount of time, I even did this with a vehicle. When I was younger, I used to have cars that were not brand new. And instead of paying the extra money in insurance, which wound up being $1,000 a year for collision insurance, I would just take the car without collision and save the $1,000 a month. So within 10 years, this account had about $17,000 in it. So I would now say when I went to a company, say Best Buy, and I bought a new TV, would you like insurance? Oh, you must insurance. It's great. You have to have it. I would say, no, I'm self-insured. And oftentimes they just don't say anything, but sometimes they say, well, what does that mean? And then I would explain to them how I would save all the insurance money. I have this big pile of money now in an account that I use in case anything breaks, and I fund the replacement of it directly rather than paying somebody else, paying Best Buy to insure it for me. And the reason that I was able to accumulate so much money is that most products today don't break. And most products today you're wasting your money on warranty insurance. So the point of this whole story is that being self-insured often costs companies less. It is often a significant savings. So if you're a relatively large employer, it makes sense to try self-insurance, where you're going to pay. Oftentimes they'll have it where, as a self-insurer, you're going to be covering all the costs associated to a certain amount. Maybe it's $1 million. Then after that, the insurance, they'll cover the rest. So they'll have like a catastrophic ceiling. So that, God forbid one employee doesn't have $7 million worth of medical bills, which, I guess is possible with today's medical costs. So most companies have partial self-insurance, but plenty of companies do have full self-insurance, where they, in some cases, they'll have what's called a stop-loss insurance, where they're going to, there's, like I was explaining before, there's a certain point where the company pays out X amount of money, then that's the stop, and then the insurance companies will take on the additional loss. Now, some employers have administration services only, which means you go to an insurer and you say, listen, we're going to pay for everything, but we want to use you as our administrator. So we can tap into your networks and your administration, and we can basically pay for a much smaller fee. We'll pay for you to handle all the claims, organize all the doctors and hospitals. And basically, from the outside, from the employee, it looks just like a regular health insurance plan. But from the company point of view, they're self-insured. You're just paying an administrator to do the paperwork for them. Now, the self-insured plans are exempt from state laws that require insurance plans to offer certain state mandated benefits. So that's another way of reducing costs. So since you're exempt from the state laws that insurance companies have to, certain coverages insurance companies have to maintain, you can tailor your medical expense or health insurance in a way that is going to be even more low cost, because there's a lot of basics that you may not have to cover. So this, as an employee, it's good to know whether you're joining a self-insured medical plan or a more traditional medical plan through a group medical insurer. Because if it's going to be a self-insured plan, you may want to ask or look into how does this plan differ in its insurance from the state mandated minimums. Okay. Now, managed care plans. So these, what you could sometimes call a fee-for-service plans, they're not as popular as they used to be. And they account for a very small percentage of people who are covered with these anymore. And what basically physicians were paid a fee for each covered service. So employees would select their own physician, and then whatever the physician did, they would get paid a fee from the insurance company. So the plans would have what would be, and this is sometimes more typical for dental. So the plans would have what they'd say, this is what our usual, customary, and reasonable fees. So they'll set a schedule saying this is what we'll pay for these fees, these services, these medical services. So if you go to any physician you want, and if they charge more than our fees that we set for reimbursement, you as the patient will have to pay the difference. The benefit to the managed care plan in this way is that they know what they're going to pay. So they don't have to worry about price increases or someone going to a more expensive doctor than another. That's all left for the patient to worry about. So it's a much more predictable plan, but these are just not really popular or utilized much anymore these days. And the managed care is just a generic name for for medical expense plans that provide coverage services through the members in a cost-effective manner. So when you say managed care, it's really saying we're going to be an outside entity to intervene and manage the care with the idea of hopefully lowering the costs. So what we want with these managed care is we're hoping that they're going to provide a environment where healthcare become more manageable and make more financial sense. Okay, so let's talk about a health maintenance organization, or an HMO. And this is a pretty fairly common entity you're going to encounter at work. So HMOs are, I'd say, one of the most popular types of managed care plans. And it's going to be an organization that's going to put together a healthcare system to provide, comprehensive medical services to the members on a prepaid basis. So they're going to negotiate, these HMOs, they're going to get together and negotiate rates and enter into agreements with hospitals and physicians to provide medical services. So they basically are going to try and work out the best deals possible up front and agreements on what they'll pay. So if a hospital or a doctor group join an HMO, they're going to sign a contract and agree that these services are performed. This is what, we expect you to compensate us for doing those services. So they're very comprehensive, and everything is spelled out in the contract. They're very lengthy, and because of this, the choice of providers are rather limited. So they're not going to work to get everybody on this HMO, but they're going to get a equivalent amount, a reasonable amount of coverage, so they can facilitate and work with the doctors and hospitals to do sort of a cost-sharing provisions, so that way they can try to manage the overall costs. Now, as far as hospitals and doctors, they like the fact that these HMO plans will bring them lots of business, but they don't like the fact that it limits the amount that they can charge for their services. So it's sort of a damned if you do, damned if you don't scenario. But the HMOs, the more that the HMO can save, the more profits they make, because the HMO is going to basically sell their managed care to companies, and companies will pay them per employee. So the difference between what the employees and the company are paying for the medical insurance versus what the HMO has to pay to the doctors in the hospital is their profit. So they want to make sure that they're going to operate their network at a profit, not at a loss. And oftentimes that escalates medical costs because they want to make sure that there's a middleman involved now. So rather than just having, the patient and the doctor with the employer paying in the middle, now you have the patient, the employer, the managed healthcare system, and then the doctor. So it's another person in the mix that's going to get their slice of the pie or profits. Sometimes providers may receive what's called capitalization fee, and this is a fixed annual amount for each plan member, regardless of the frequency or the type of services provided. So this is just like a flat fee per person. Now, employers can, of course, if employers work together, they can make a purchasing cooperative to try to obtain more favorable prices from an HMO. So if you come to an HMO and you represent 16 different employers and 100,000 employees, they're going to want your business. So they'll give you basically a discount for being a purchasative cooperative coming into the HMO. Now, a gatekeeper physician, this is going to be typically your primary care physician is going to be the gatekeeper, and they're going to determine what medical care you're going to receive and what specialists you can go see. So when you have a gatekeeper, you have to go see your primary care physician, discuss your medical problem with them, and then if they agree, either they'll treat you there, or if they agree, they can refer you to a specialist. But you can't, if you go to the specialist without getting your primary care physician's approval, then you're responsible for paying the cost of that care. Okay, so there are several types of HMOs. You could have what could be a staff model. So these are going to be where the physicians work for the HMO and they're paid a salary from the HMO and they receive an incentive or a bonus to hold down costs. So here's a case where, as a doctor, you're hired by the HMO, not by the hospital, you're not in your own practice or somebody else's practice. You work directly for the HMO. And then you're incentivized to hopefully target the costs to the patient. So what you want to do as a physician, of course, you always want to treat the patient as best as possible, but you want to discourage unnecessary medical procedures or tests that are not needed. So lots of times the employee may come to the doctor and say, oh, I feel like I need this, I want this medication, I want these tests. And then the doctor, within, of course, medical reason, would try to dissuade procedures or medications that are not needed, or explain to the employee that this is a better way of going. Instead of taking the medication, just lose 20 pounds or however that would work. Now, under a group model, physicians are employees of another group that's a contract with the HMO. So you could be there could be a physician corporation or a medical practice that has working for them 40 physicians. So the medical practice will make a contract with the HMO. So the individual physicians won't do it, but the group that they work for will go to the HMO and say, hey, we have these physicians working in these clinics, and we want to get patients from your HMO. And they form a negotiation and they sign a contract. And basically it spells out exactly what services the HMO will reimburse the doctors for performing on the members of the HMO. Now, under a network model, the HMO is going to contract 2 or more independent group practices, and they'll form a network. So the HMO will basically form a network of practices that it won't just be one practice, it won't be a group model, it will be a network model where they'll have multiple practices. And this is for HMOs that typically are larger and cover bigger parts of territories, and to make sure coverage is evenly spread out so that it's attractive to multiple employers. Now, an IPA, not the tasty beverage, but the individual practice association plan. This is a type of HMO where physicians work together out of their own offices. So it's a panel of physicians that are going to, they will treat HMO members, but at reduced fees. So they're going to agree to allow these members to come to their practice, pay charge a reduced fee for the same services that they charge a higher fee for the regular patients who aren't part of the HMO. And the IPAs, they can have a risk-sharing agreement with the participating physicians, so the physicians are rewarded if they reduce the plan's expenses, or if the costs are better controlled or the better outcomes. So it's just another type of care plan. Talk about what a PPO is. The PPO stands for Preferred Provider Organization, and it's going to be a plan that's going to form a contract with with multiple healthcare providers to provide an agreed upon services to the members at discounted fees. So deductibles and co-insurance charges are reduced when patients use the PPO provider. So this type of healthcare plan, it's stressed that you should use the PPO providers because you as a individual are going to get the lowest cost of your medical service will come from the physicians within the PPO. So basically, they negotiate ahead of time with these providers to get, the lowest cost possible. So as for the providers, they are giving up some of their profits, but they're generating lots of business by contracting with these healthcare companies. Now, don't confuse the PPO with the HMO. So there are important differences between them. So the PPO provides different. It's slightly different, but let's talk about what the PPO doesn't provide. They don't provide medical care on a fixed or prepaid basis, but are paid as fee for service. So they're only paid when they perform the fees. So they don't get an overall blanket of money. They get money when they actually do something. And those, of course, those fees are negotiated ahead of time. And they usually always, of course, they're always below what the provider would charge a patient without insurance or without being part of that managed network. So unlike the HMOs, patients are not required to use the providers in the plan. They have the freedom to choose any physician they like, any hospital, and that's a level of flexibility and freedom that people like in the medical plan. However, if you do choose to use the physicians in the plan, you have a financial incentive because the costs will be much lower than if you go outside of the PPO and physicians. Now, in addition, healthcare providers, their normal fee usually exceeds the negotiated fee. So the providers absorb, the difference. So, in these cases, savings to the patients can be substantial because you're basically getting a pre-negotiated rate for the service, and then much of that would be covered by the insurance. So assume that a surgeon, or a physician who participates in the PPO is going to have a fee of $1,000, typically for the person that comes in to get that service. But, now for the regular fee, for someone who's in the PPO, instead of charging you $1,000, they may only charge you $400 because that's been the negotiated rate. So you don't pay the additional difference. The surgeon or the physician will absorb that difference. So it's basically negotiating for discounted medical care because the providers get a group of patients or customers, so that's their incentive to participate. And the insurance companies get lower costs. Now, with the PPO, there's generally not a primary care physician gatekeeper to direct the patients to go or not go to a specialist. So they don't have to get permission to go wherever you want, but you're basically giving a list. Here's the physicians within our medical plan. Stay with them. And the cost will be either nothing or greatly reduced. Now, as in the contrast to this, to control costs, the HMO generally requires members to obtain permission from the primary care physician before they see a specialist. So just two different ways of doing it. So the PPO, it gives you more freedom as a patient. You may be willing to pay more for a better physician that's outside the plan. And in most cases, you'll probably stay inside the plan to save costs, especially when the quality of physician is not a matter. With the HMOs, you're locked into a subset of providers and their referrals to specialists that limits your choice. And that's typically why, in many cases, the PPO could be more expensive to the end consumer than the HMO, because the HMO is more tightly controlled. Okay. 7 of 7, finally. The point of service or POS plans. And now this is another type of plan. And you can see, now you can get an understanding why the medical benefits are so confusing. And part of the complaint for U.S. healthcare is there's so many of these options and different plans and different organizations, physicians and hospitals and insurers that all drives up the cost by becoming less efficient. But when we're talking a point of service plan, we're looking at the type of managed care that's going to combine the basics of the HMO and the PPO. So it's sort of a hybrid plan, but the members have the options to select care outside the network, So what they're going to do is they're going to create a basic HMO for the members, along with a PPO element to it. So sort of trying to get the best of both worlds. So if you as a patient, you want to stay in network, you pay little or nothing out of pocket. But if you want to go out of network, you're going to pay more. Now, POS plans do establish a network of preferred physicians. Members can select a primary care physician, and they can provide basic healthcare needs at the time the medical care is needed. So the plan has options to care within the network or go outside the network. So this way you kind of get the best of both worlds. If you want to go outside the network, you can pay for the providers outside the network. If you want to stay inside the network and save the money, you can do that as well. Now, it may seem awfully similar to a PPO plan, but the point of service plans are different because how can I explain? One, generally they do not require you to select a primary care physician. So we know that a PPO, you don't have to select a primary care physician, but with a point of service, you do. Now, so the point of service plan is going to require, that gatekeeper like an HMO. So that's why it's not a PPO, it's a POS, which is abbreviation, because you have that gatekeeper function within the network. Also, when you do the PPO, which we were talking about before, you can directly select the specialist that you want to work with without getting approval because you don't have a gatekeeper. But with the point of service plans, you may require to inform the gatekeeper or your primary care physician that you're going to go outside the network, so that the physician can recommend different specialists within the network as an option for you. But however, you're still free to go outside the network. So probably the POS gives you the biggest level of freedom outside of the network, or probably the most degrees of freedoms for a managed healthcare plan. So that's a major advantage. You get that freedom of choice for your medical care. And it's also particularly useful if you live in an area where there are not a lot of providers, or you may not have a lot of providers within your healthcare plan. So you're going to have to go outside the network for coverage. And that's why a POS would be useful. So that's why you need to know what is the coverage aspects of the medical plans in your area. Are you in an area that's, if you're in a highly densely populated area or a city, you probably will be fine with a PPO or a HMO. But if you're in a more rural area where there are as many as choices and you may not have maybe only one physician in plan for that specialty and you need to get something done quickly, you may not have the option. But with the POS, you can have the option to go somewhere else and see another doctor of your choice. But the major disadvantage would be the costs are higher, especially the cost for deductibles, co-insurance, and other charges for care you're going to receive out the network are going to be much higher. Okay, so I'm going to end part 1 of the Chapter 16 lecture here, and we'll pick up part 2 on the ACA and how that affects group medical care next time.